everyone, this is Matt Williams with JTM Williams Capital Management. This is the recap for the month ending April 2026. I'm recording this video on Sunday, May 2nd, 2026. As a reminder, the ETFs, indexes, and securities mentioned in this video are for illustrative purposes only and do not constitute a recommendation to buy or sell. Please refer to the disclosures at the beginning and end of this video. The theme of this video, for the month ending April of 2026, I want to go over breadth and we're going to talk about inflation expectations. So we're going to get started. I'll share my screen. I'll start off with the S&P. Now, obviously the S&P 500 here in April, we made back all of the losses from the down move in March, which was approximately about a 10% correction. I made it back and then some, and we ended up ending April at a new all-time high. Now, again, going back and saying what's the one thing I want to go over, which is breadth. The rally off the lows, has been very narrow. So we're going to start off, I'll show, as we typically do, with relationships as far as which sectors are leading, and we'll go through there. So we'll start off with, as I mentioned at the beginning of the year, I was a little concerned about the makeup of relative strength. It was a lot of the defensive sectors that were leading the NASDAQ. Most of the growth sectors were showing weakness. And as I said, that was a yellow light. It wasn't that point saying, hey, sell everything, go to cash, get short, but it was yellow. I mean, it did in some cases end up foreshadowing that 10% correction we had there in March. So as you'll see, really the only sector here that's showing relative strength, now this is the NASDAQ, this is tech. This is fairly similar to what happened last year, where I believe the statistic was at the end of October of last year, the only sector outperforming the S&P in the previous 6 months was the technology sector. And again, a lot of that was powered off of the AI move, semiconductors, etc. So we'll go moving on. Again, as you'll see, there's really nothing here. Energy is in some cases holding up. But again, the only sector right now that's really holding up is tech. Now, again, semiconductors, which are now roughly half of the tech index, are really what's powering this move higher. What I want to show here now is breadth. So here's the S&P 500. Here's this is the risk appetite ratios I looking at. NASDAQ 100 is outperforming. Consumer discretionary really didn't show the type of weakness here on this down move. This is one of those things that kept me from getting overly bearish there in March, where it was, again, to me, kind of confusing where, okay, the market keeps heading lower. Some of these risk appetite ratios aren't really breaking down. So I think Wall Street was rotating into parts of these markets in anticipation of, again, there being a deal, or what's going on over in the Middle East isn't actually being as negative as what one would think. So again, high betas outperforming low vol, credit spreads are continuing to improve. So again, this is showing that there is some risk appetite under the surface of the market. Now again, here's the breadth chart I want to show. So again, the top panel, S&P 500. The next are the percent of stocks above the 20, 50, 200-day moving average, and the bullish percent index, which is again another measure of breadth. As you'll see here, the last 2 weeks on the second leg higher, you had this breadth explosion that occurred from the end of March until around, call it April 20th. The number of stocks that have been carrying this last leg of the market higher has started declining. And what I'll show here is that even though, let me go back here. So even though the S&P, as you can see here, has broken above and started making a new high, the previous high, we just call it 7,000. We're sitting a little bit above 7,200. If you look at the equal weight S&P, it is not actually above its February high. And if anything here, the last couple of weeks is shown here by breadth. The average stock, where it was outperforming going back to around Halloween, and I was pointing this out in some videos here in December, January, and February, the average stock's been lagging. This has very much been a mega cap technology-led rally, which again, the old analogy, you want your best players on the court scoring the most points. That has been what's happening. Albeit, what I'll say is if there is some concern here that the market's getting incredibly narrow, sometimes that does end up foreshadowing some pullbacks. It would not shock me at all here at this point if we didn't have a pullback, down to test this breakout or come back down to, one of these moving averages before potentially heading higher. Again, this is something else showing that, whereas the average stock still hasn't taken out its previous high, the NASDAQ, which again was lagging there for, several months on a relative basis, has been, what's led this market higher. And again, we've taken out the previous highs. Again, would not shock me at all to see some pullback, a give back, which could potentially end up being a pretty good buying opportunity. Now, I said in the beginning of the video, what was the second thing going to be? Inflation expectations. So what I want to get into now is the big story here, really ever since the end of February, with what's going on over the Middle East, has been oil, commodities, and what that has done for inflation expectations and interest rates. Okay, so next, we'll go to Brent crude. Again here, right before the conflict started, it was sitting somewhere around, call it $70 a barrel. We're still sitting well above 100 moving forward. Here is the inflation expectations. And what I'm using as a proxy are inflation protected bonds relative to treasuries. So this ratio goes down, inflation expectations are falling, ratio goes up, inflation expectations are rising. As you can see, when this really started taking off, again, right at the beginning of March, right when oil started spiking, right when this conflict began. And you can see there is a pretty strong correlation here going back several years between inflation expectations here on the top and the 10-year yield here on the bottom. And you can move down. Here's the CRB index, which is a commodity index. And again, normally when you start seeing spikes in this is when you can see that there are spikes in interest rates. Last thing I want to go over, with what's going on here with inflation expectations is I shared this chart here in one of my previous updates at the beginning of the year. This is the chart, the 2-year yield. This is most reflected in what could be correlated to Federal Reserve policy. My big concern here is that, and again, I just look at charts. I'm not, my job is not to be an economist. I've pointed this out to some of my friends that are economists, and I think, the consensus, amongst us is, we really can't see, given the political environment, what could end up causing the Fed to actually hike rates here. Now, again, the market's way smarter than all of us, so the market's going to end up dictating, what the Fed ends up doing with interest rates. But what I'll say, what concerns me here is we've pinged in between roughly 3.5% and 5.25% here ever since this big inflation spike, that we had, coming out of the COVID lows, where the Fed had to start hiking rates from effectively zero bound all the way up to 5.25%, and have been, cutting now here in recent years. What I'm concerned about is we don't know what could be coming down the pipe. Again, the bond market is way smarter than all of us are. I believe it's way smarter than the Federal Reserve, and it's going to end up telling or dictating, what ends up happening with interest rate policy. And where I'll say there's at least a concern of mine, and I mentioned this again a few months ago, is if I draw this line here, this downtrend, it looks like to me where I originally, and I think a lot of market participants saw this as a big head and shoulders pattern that was going to end up resolving to where it's down somewhere around, call it 2 to 2.5%, assuming that the Fed was going to keep its interest rates, its cutting policy moving forward. That this looks to me like it is a breakout of a downtrend. We had a check back, and now we're heading higher. To me, if I'm looking at this purely as a chart on a chart perspective, this would potentially be forecasting that the 2-year yield and or interest rates could get somewhere between 5.25%, 6%. Now, as I've said in conversations, I have no idea what could cause that, what the economy is going to be looking like if the Fed has to reverse course and start hiking rates in excess of 5%. Again, this is not a prediction. I'm looking at it in terms of charts. I did have a conversation with an economist friend of mine that I said, the market is always interesting in what it's discounting and what it's looking forward to. I always liken, a story I tell of the gold chart from December of 2009 until roughly August of 2010, where it looked like it was making just a massive cup and handle pattern that was forecasting dramatically higher gold prices. And that late summer, everyone was asking, okay, what could gold be discounting, or what could it be looking forward to? And we didn't realize that a few weeks later, Chairman Bernanke was going to end up announcing at Jackson Hole the Fed was going to launch the second round of quantitative easing, and gold then started taking off and rallied about 25% over the next few months. So again, the market's smarter than all of us. All we can do is listen to it and try to make the best moves we can. So again, this is a recap for April 2026. We'll see what May has end up in store for us. If anybody has a question or would like to reach out to me, please. My email is matt@jtmwilliams.com. My website is jtmwilliams.com. I can be reached at 703-782-3110. I look forward to your questions and hope everyone has a great month of May. I'll be putting out another potential mid-month update or as the market dictates. So again, hope everybody has a great week. I look forward to hearing from you. Have a good weekend.